Hi, very good morning to everyone here. Thank you for joining us for this special panel discussion on value unlock. So, to kick things off, I'd like to invite the head of capital market development, Mr. Chan Kam Kong, to give some opening remarks.
Morning, everyone. Happy New Year. Thanks for taking time to join us today. We would like to sort of start the year off with, the energy that Boon Chai and Minister has talked about. So now today's session, we want to dive in a little bit more into the Value Unlock program. So we do know that there's a whole slew of measures that has been put out by MAS. And then this is about getting into the psyche and the position of a listed company and what needs to be done, right? And what are the programs in store for that. But before we jump straight in, I wanted to give two slides on context and perhaps explain a little bit of the whys that we want to achieve coming out of this. I was wondering whether this is for the slides. Okay. Okay. So what we're going to walk through in terms of the stock market, a quick short recap, macro view, and what is the desired end state. And then value unlock itself. Why should companies bother, right? And then an overview of what's in store for companies in terms of the value unlock program that we have. And then we have a very good panel to give you insights from the different perspective that we have put in store for you. Now, quick recap. I think if you look at the index performance over the past 2 years, you see a blue line, which is the actual index performance, but right on top of that is the green line. That's the Bloomberg consensus target price for the index. Yeah. So just to give you a sense in terms of that, and that has been revised up as well in terms of the green line, around about 15% in the middle of last year. So in total, over the past 2 years, the market has done relatively well, up total returns about 60%. I think the biggest question is what's next? So, which is why we want to put out a few of the forecasts that the various brokerage houses, the research firms, has indicated as a sign of where things could end up. So you have CLSA and Citi very close to the 5,000 mark. JP Morgan, likewise, in a blue sky is 6,000. Otherwise, a base case of 5,000 for calendar year 26. Now, DBS has got the highest number out there, but it's a further out time horizon, 10,000. That's a doubling from where we are now. So these are interesting numbers. Each and every one of these houses would have their, assumptions, so on and so forth, baked in. So if you are keen to know more, you can engage them and see what are some of the assumptions there. But I just wanted to put this out there and say, okay, this is where some of the analysts and the market is thinking about it. How do we get there is probably the next question. There will be macro factors, investor sentiment, trade, tariffs, and all that to contend with. But those are macro, beyond our control. We can't do a lot about that. But what we can control and what we can do about it is in terms of as a market, it's, collectively listed companies, if you are able to communicate better, lever up our communication, our engagement with investors, and also very importantly, go through a inside out assessment of where the strength weaknesses are, and then combine that with the value unlock program that the team is putting together. We've worked together with MAS to put together a program to help you in that journey, and we can move towards that. So this is about a very basic what we can do about this in order to reach some of the targets put out there. Although it's a different time horizon, but I think it is a very positive signal. Now, the next slide This is a value up initiative in Japan and Korea, and both have developed positive results. Now, the red line represents the FTSE, the light blue is Kospi index, and then the gray will be topics. Yeah. So as you can tell, both Japan and on the x-axis is the number of days since they first announced the value up program by the respective exchanges. On the y-axis, it is the percentage change in terms of the price index. So what does it tell you? Since the announcement, both of them have leveled up. In the case of Kospi, they have leveled up, but we've got to see whether it continues to stay sustained. In the case of Japan topics, it has leveled up and it has been sustained. Now, there were blips that you see drops there, and there were probably macro factors. Tariffs were hit and then they had a blip down, but then look at where it has bounced back. It's on a higher level. Now, we would like to work to achieve that level of resilience for our market. Still early days, but this is something that we're looking to replicate in our market. So this is why we are embarking on this effort to try and bring this, to level up our market on the back of the momentum that we have seen so far. Now, this will involve changes to the way we have been thinking, dealing, and working with investors buy side. Maybe uncomfortable changes, because I know for LISCO's standpoint, investor relations, while important, a lot of them will find that they are actually strapped for time, strapped for resourcing, and so on and so forth. So the top part has been done for a lot of these companies. There is actually latent value in it. They are doing, what they can to grow their businesses. But the last leg of explaining that, being able to pitch it convincingly and pitch your story at the right level. When you're talking to an institutional fund house, or whether you're talking to a retail crowd, may take a slightly nuanced approach. This is where some of these programs that we're going to put together help you sensitize yourself to the changes there, so that you can make a more effective connection with your investors at the end of the day, right? So I think that's what we're trying to achieve over here. Now, why bother? I think first and foremost that comes to mind, put yourself in the shoes of the owner of a company. You want to do all this, you want to attract investors, your valuation get enhanced, all right, and you achieve a lower cost of capital. I think that in essence, it is not about just meeting investors, so on and so forth, talking and etc. There must be an ROI, there must be an outcome that you're working towards. And I think we try to crystallize that into broadly this three area. And if you are the owner of a company, if your valuation goes up from 10 times PE to 15 times PE, which we have seen in the past 6 months, there were a number of placement transactions in excess of, I think, 20 over transactions the second half of the year. Some of these companies were under the radar partly because of EQDP. There was a stimulus, there was a catalyst for the fund managers to discover these companies. Their valuation have moved from, I think, 0.8, 0.7, 0.8 times book to closer to a one-time book, right? That's a meaningful 30%. In some cases, from a PE standpoint, they have doubled their valuation. If you're the owner of the company, or you have your stock options, your ESOP program, that means a lot to you personally as a professional management as well, right? So I think these are the things that's going to hit home when you go back, when the LISCOs go back and assess and explain the situation. Now, when you do a placement at a much higher valuation, let's say from 10 times to 15 times, the dilution to your shareholders is less, and that's your currency. And you can use that additional monies to fund a few things: growth, pay down debt, acquisitions, right? So those are the benefits that you will see arriving out of all these actions that are put together. So there is an ROI on the back of all this effort. Now, in a value unlock program, you see the last line out there. Basically, I'm oversimplifying, but the panel is going to give you a lot more color. It will the unlock journey would involve diagnostics, which is what we talked about. You gotta have a look at your operations. Where are your strengths? Where are your weaknesses? And what are the opportunities out there? And then the next step, you need to plan for it. You need to have a strategy of how you're going to tackle that in terms of whether there are new market opportunities. And then an implementation. Plan and ideas are cheap, as we always say, but the implementation is key. How to get through the implementation process is also very important. And the last leg of it is then how do you pitch your story to the audience, right? The communication part of it that we talked about earlier on. And what I meant by communication is got to be effective, able to connect your story. So with that, this is the Value Unlock program. Three main pillars that you read about in the media already. There's a capabilities, there's a communication, and then there's a communities. We talk about the communities later. From capability standpoint, is basically training, right? There are two levels of training. There's a $30 million grant. The equip grant is more for training purposes where you can send your staff for investor relations or media training, corporate strategy and financial management in those areas. There's a 15,000 per company limit at a 50% co-funding level. Then the next grant is the Elevate grant where you can engage professional services. This is for companies to level up, right? Where they need help. You need a personal coach, you need a personal trainer, whatever you call it. The amount is meaningful, 200,000 per company. Again, it is a 50% co-funding. The co-funding is basically to ensure that there is a skin in the game, and these are taxpayers' money. We want to make sure that this is well spent. So Liscos has got to demonstrate commitment and skin in the game. There will be certain outcomes that we want, certain KPIs after the training. Train, but then nothing comes out of it is a waste of money, right? How to engage. We will require you to put that into practice to engage investors. And we will be there with the brokers, the brokerage community to provide you with opportunities to meet up with investors, both institutional as well as retail, right? I think communication we spoke about. I don't want to read line by line and stuff like that. So it's fairly straightforward. There will be a training program to help you with that. Now, on the last leg, there will be communities. It starts from the very top. A lot of these initiatives, there's a bottom-up and top-down element, but we'll be looking at the directors, CEOs of the company, C-suites of the company to take leadership and support, the efforts in this area, because this is an important one, as you saw in the first two slides. This collectively, we can help the market level up from a valuation standpoint, and that in turn has its benefits that flows back into the individual company. Now, last bit, this is a sort of snapshot of all the grants. Yeah, it may be useful to take a photo of it. Now, a lot of times, we face a chicken and egg situation. Should we have demand first? And then with that, IPO will come. And then there's the other school of thought. You have good IPOs, the demand will come. So there was a big tussle at the onset about, which is more important. And I think the conclusion, I suppose, is you need both sides. But personally, I would prioritize demand as an initial step, which we have. MAS has done a lot of work, engaged with the professionals in the industry, and the program that has come out. I think EQTB was a big catalyst to this. And then the next step, as you see on the right-hand side, there will be the global listing platform, right, that will tackle on the supply side. Then what do we do for the existing suite of 600 companies on the list goes? Squarely falls into value unlock, right? So we are tackling things quite holistically, demand, supply, and then the existing pool, what do we need to do to make sure that they are not lost? So existing companies, a lot of them are doing good work, but there will be some that requires assistance. So we will be there with you on this journey. Now, with that, I would close off the opening remark, and I'm going to hand over to our panel of moderator and speakers. I would like to first introduce Mr. Shik Wang, EY-Parthenon representing. He'll be the moderator. We have Kong Chi Ming, CEO, Centurion Corp. We have Lai Yu Huan, Amova Asset Management. And finally, Michael from SGX RegCo. Shik, I hand it over to you.
Thank you so much. Please have a seat. Yes. Ladies and gentlemen, hope that you had a good year-end break, and then good morning, and then thank you for having us today. So I just came back from the very nice holiday in Korea. Generally, whenever I visit Korea to see my friends and family, they ask me to treat them well because Sing dollar is getting stronger and stronger. So they know, right? They think that I'm getting richer and richer. But this is the year-end break. People start to treat me well. My friends are buying the drinks and dinner. And then they are so much happy to see the 76% of the stock exchange market growth last year. You saw that number, right? That's the what we want to discuss today, right? I mean, it's fundamentally Korean companies are all same, but simply they did the right thing in the ecosystem of the capital market. And then all of a sudden, 70%, more than 70% increase. So today we are talking about value unlock, which is different from how to create the value. Value unlock means there's a value. However, it wasn't not well known. It was not fully realized. So today we want to talk about the value unlock. So then to talk about the value unlock, there are 4 different ecosystem participants are critical, right? So number 1, we need a regulator. So Michael will represent the regulator perspective. We need money, demand side, right? We need a capital allocator. So we also have the Huan from the Amova. And then last but not least, we need to have operator who's going to run the money. So we have the Chee from the Centurion Corporation. Also, you heard that the planet is still cheap, but it's very important. So I'm representing the consultant as a planner advisor. So I kind of helping out around the advisor side. So for us, if we discuss for the next 45 minutes, okay, in Singapore, we can really think about, wow, how can we unlock the value, right? So I will ask the first question to all of the people introducing themselves, because some people might not be familiar with where they're coming from, but you will impressed the level of value unlock, the level of depth about the thinking. Also, still, they want to do a lot more, right? So I will ask them to introduce themselves, but I want to ask the one question first. What's the definition of the value unlock to you? Regulators, capital allocator, and then operator. Okay. So let me start from the right side, the Michael. Okay, introduce yourself. SGX, we are quite happy, but introduce yourself. And what's the definition of the value unlock?
Sure. Thank you, Josek, and good morning, everyone. Happy New Year. I'm Michael Tang from SGX RegCo. I head up the listing compliance function, which regulates our listed companies. So to answer your question on definition of value unlock, I think nowadays, a lot of people look at Korea and Japan as the paradigm for how value is unlocked. But I mean, I wanted to go maybe a bit further into the 80s, where this gentleman called Jack Welch, who was the chief executive of General Electric, first, I think, pioneered the modern concept of unlocking shareholder value. So he was, as I mentioned, CEO of GE in the 80s through to 2000. And he actually raised the market cap of GE from 14 billion to 600 billion US dollars by selling underperforming assets as well as cutting costs. What he said is that shareholder value is a result. It's not a strategy. It is the product of the combined efforts of management as well as employees. And the main constituents of unlocking value are your employees, your customers, and your products. So really back to basics, right? This is about how to run a business. So what this means really is that for a company to unlock value, you need to understand where you stand and what are your competitive advantage, and then to leverage on that. And what it requires is a strategy, like you mentioned, but unlocking value itself is not the strategy; it's the end result.
Got it. Thank you so much. So we heard about the Jack Welch. It's a combination of the whole this ecosystem to really happen, to make it happen, right? Okay, Yuhan. So what is your definition? And then also people keen to understand the Amova. Right? I mean, you are
Sure.
well known in a way, but please.
Sure. Amova may be a newish name to some of you. We used to be known as Nikko Asset Management. We are obviously Asian, one of the largest Asian-based and Tokyo headquartered asset managers. But we have had a long history of managing Singapore equities, including managing some of the largest and oldest single country funds investing in Singapore. And so to answer your question on what is value unlock, right? If you come from the point of view of an investor, what's value? Value is quite simply a listed valuation that understates the true intrinsic value of a company. And a true intrinsic value of a company could be based on the evaluation of its operations or the private market valuation of its assets. So to us, value exists when there's a gap between these two valuations, the private market valuation versus the public market valuation, which is the value of your shares. And so in a value unlock program, what we are looking for really is a plan to bridge these two valuations. We are looking for a recognition from companies that there is a gap. There is a gap, and there is a strategy to bridge the gap between the public market valuation, which is the share price, and the intrinsic valuation, which could be backed by your operations or the value of your assets. Kind of that's how we look at it.
Yeah. Thank you. Thank you. So Amova is one of the few fund manager very focusing on the Singapore market. So I'm going to ask the question, why Singapore? Are you benefit from the Singapore dedicated fund manager? So we're going to ask that question. Chee, you're representing the operator, right? And then so people are looking at your shareholder price, 3 times better than the last 5 years. What's the secret and what's your definition?
Secret. Okay, let's not share the secret yet. But okay, my name is Jimin. I'm the CEO of Centurion Corporation. I'm not sure everyone knows us, but if not, then I think we are not doing a good service in terms of communication. And that's what is this unlocking value program is all about, which is why we are here to share a bit on our journey towards the unlocking of value. So for Centurion Corporation Limited, our focus is actually in 2 core business. In fact, there's a third one, but what primarily we are doing is actually specialized asset classes, living asset classes in student accommodation and workers accommodation. Now, this segment, it is not very easy to understand with, right? Particularly for workers accommodation, which is quite unique in different, not unique in the Asian countries, right? Not the European countries. And so a lot of communications needs to be done. So what is the definition of value creation, or rather value unlock to us, is purely recognizing or having the market to recognize our true value of the company and our business, right? And it is all about how to narrow the gap between the share price and also the fundamentals of our business. Okay, we have actually done quite a fair bit over the last, or I would say, last 3 years, right? Having to be able to grow our share price. In fact, my company's journey starting from 1996. In fact, we were listed in 1996. In 2011, got a reverse acquisition, pivoted to a totally new business. Prior to that, we do optical disc media manufacturing. Thereafter, in 2011, I was appointed CEO, and my task is actually to pivot the company to a new business, which is a combination of the living sector business. And the journey has not been easy, I would say, in terms of unlocking value, like what you mentioned. We have been trying. Our business is, the value creation is there because every year on year, our profits is record, right? Every year on year for the last 15, would say 14 years, right? But the market is not recognizing the value, right? Just last 3 years, 3 years ago, if you look at our share price is probably near to 50 cents, right? And our price to book is about 50%. So our discount is about 50%. P ratio probably about 4 to 5%. Now our share price is actually at today, I think it's $1.37. That's actually has elevated
3 times or about 3 times. And the market is recognizing the book value, I would say price to book value, close to our book value, because our assets are really hard assets where it's highly sought after, both workers and student accommodation. So the disappointment for us is that, wow, how come in the first place the market is not recognizing the value? So through the hard work over the last 3 years in terms of communicating, plus also the EQDP has actually attracted quite a fair amount of different investors that are looking at us. And I believe that is where it has actually unlocked value for us. Okay.
I see. So the business model change, also communication is quite critical, right? So let me a little bit of step back. So starting from the capital allocation, right? So before I ask more detailed questions. So Yuan, we also we call it value trap versus value unlock, right? Value trap. So what is your definition to you about value trap? Are you scared about value trap? How do you avoid the value trap? Or are you looking at the value trap and then trying to pivot? What is the capital strategy in Singapore market?
So this is a question of sort of like what kind of investment process or investment philosophy we have, right? So for us, what matters most is harnessing fundamental change, right? So when we see value, we ask, is there fundamental change going on? If we don't, and we are willing to exercise our imagination together with management in terms of what change is possible, we can look beyond the immediate term to the medium to the long term. But if there's seriously no change, no intention of changing, no ability to change, then that's where we call it a value trap. We're not in undervalued companies for its own sake. We need to see some kernel of recognition that the change is necessary and change can be forthcoming and change can drive the realization of that value. It's looking for this change that differentiates value unlock versus a value trap, in our view.
Can you give us some example of what kind of changes most significantly you are expecting?
Very typically, we look for either ownership change or management change, for example, right? We've had, let's say, new management coming into some of the large property companies in Singapore. That has catalyzed strategic reviews because perhaps the founding families realized that the value of the company has languished for the longest time, has changed some of the management. And these are some of the kind of changes that we look for. We look for perhaps changes in the perception of the market towards certain businesses, which are perhaps new to us for a number of years, but we may take the time to understand the business, to recognize that these things are structural in terms of their growth potential. Also, that could be a change as well. Growth is also a change. So to us, we are quite varied in terms of the kind of change that we look for, but certainly there being change is critical for us.
No, I see. So new capability needs to come in and the new strategy needs to come in. That's the definition. That's your target definition.
That's right.
So you're not just happy with steady dividend.
Not value for value's sake.
Okay, got it. So the value trap here is even though steady dividend, good cash flow doesn't mean that it's a value unlock. Value unlock requires a change.
That's right.
Okay, got it. So then, Michael, we heard that Singapore Exchange is great, transparent, right? And they're very, very attractive in a way. However, many of the good, even though there are many good companies, very good cash generative company, right? I don't know how many companies actually less than 1 PB, right? So private book ratio. So can you give us some sense, right? So even though there are a lot of good companies, we think that it's a relatively undervalued. From your regulator lens, what was the real fact? Is it really undervalued? And then what could be the area that we heard about the unlock program, right? So you think that you want to emphasize in the future?
Yeah, well, I think in the first place, I think there's a perception that the local market is undervalued, maybe with lower liquidity. But I think with the initiatives in the last year, through the review group, there's really been a marked change in the performance of the market as a whole. I think Kong mentioned about the EQDP as well as Chee about how it has really reinvigorated, I think, the Singapore capital markets. Maybe I'll share some statistics of the improvements in last year. As my CEO has shared as well, I mean, the number of IPOs we had last year doubled from the year before. In terms of fundraise, we raised about $2.5 billion US dollars, which is the highest since 2019. And that's the primary market performance. On the secondary market performance, we've seen the STI reaching new highs, I've mentioned, growing almost 20+% from last year. And in US dollar terms, even outperforming the Nasdaq S&P 500. In terms of the total PE of the Singapore company as a market, I think we've also seen a improvement of 16 times now, which is above the 3-year average of 14 times. Even from a price to book perspective, in the last 6 months, we've seen for smaller companies an average price to book ratio coming up from 0.77 times to close to 1 time. So I think the EQDP has given a lot of impetus to investors and have brought more investors into the ecosystem to look at how to unlock value, and look for opportunities in our Singapore listed companies. Maybe to Huan's point about, change. I think maybe from the regulatory perspective, there are really maybe two things I would say. One is that it's about a refresh. So change is also a refresh of the board to make sure that you have new perspectives on board that is suitable to meet the future plans of the company. And that's what some of the changes that were made along the years to require there to be new independent directors. That independent directors cannot serve more than 9 years on the board, so there's no close relationship and there's more independent judgment. I think the other thing I'll say about change is that it is also about growth then, right? Growth is a form of change, as you mentioned, and as a platform, our focus is really on helping companies to grow their business, to fundraise to grow their business, but also from investors' perspective to be able to have a place to invest their funds, to manage their wealth, to plan for retirement. So I think change really for me comes into perspective in terms of renewal and refresh of the board of directors, as well as ensuring that our companies are able to grow.
Got it. So the perception might be slightly misleading, but however, the direction of the change is actually we are moving to the right direction, but you want to accelerate to the time and growth, right? Okay, very good. And then I want to double click the board of directors comment later on. After I want to hear from the Chee. 10 years back, maybe 15 years ago, my personal experience, our company working on a lot about the revaluation of the asset, right? A little bit in a better cost reduction. That has been a core value, like in a way. From your end, what has been changed for the last 10 years? The effort that you are making to unlock the value. What could be the new initiatives that you are looking for the future, the value unlock?
Since you talk about 10 years ago is where we started our journey in worker accommodation, and that's where we deal into the real estate business. And you know that real estate business is very asset heavy and capital intensive. So for us, for unlocking a value during then was how we are able to optimize our debt level, right? Leverage them. And based on the asset class that we have, I think the banks are very willing to fund, right? And we are seeing how we could actually also look at different sources of debt to be able to fund our acquisitions and also our organic growth. The reason being is that during then, because our share price, as I do mention, is that it's not really visibly fair value in the market. So we cannot actually, I would say, unnecessarily dilute our shareholders. That's number one. And also, even if you raise rights issue to everyone, I would say that it is not a good outcome because the cost of capital is very high. So what we do then is more about growing the company. Of course, there are people who say in order to unlock value, maybe you should give higher dividends, right? But we are a growth company. During then, we only have 5,300 beds capacity. If we give high dividends, then where in the first place that we are able to get the money from, and therefore we have to raise money from the market again. I mean, it's a vicious cycle Like what I think the SGX mentioned is a chicken and egg situation. So the only way is that we have to bite the bullet, and therefore we have to grow in the way that we have grown. So from 5,300 beds to now we have 70,000 beds across 6 countries. That's how we grow, and that's how we have done so, and not raising any capital from the market. As you do know that for a listed company, why you want to list, the reason is actually to grow faster and also to accessibility of capital. So for now, when you look at, I think back 2 years ago, or probably 2.5 years ago, we look at our, of course, we work our balance sheet very hard as well, right? But there is certain ways that we could actually, or rather there's a certain amount that we could actually leverage on the balance sheet, because it can't be too highly geared. Highly geared investors will not like it either, because it's going to be very risky. So there's only so far that we could actually do while keeping all our matured assets on the balance sheet. So we look at the asset rationalization, we divest some of the assets, we try how to grow, we do sales and leaseback, we do a lot of, I would say, asset-like strategy. We created funds as well, right? They are making use of third-party money in order to grow. So up to a certain extent, then we look at it as look at the balance sheet. Well, our asset value is really, really, I would say, undervalued by the market in terms of share price. If we have listed these assets, right, we would have easily more than our market cap that we already have during then on then. So then the board has taken a direction to say that, okay, if that's the case, that the best is actually to look at how we could unlock this value. And that's why we appoint our bankers to evaluate the plans in terms of how best, is it a portfolio of just worker accommodation or a combination of worker and students, and which market should we not touch or rather put into the REIT. It is a journey, and I'm thankful that the journey is smooth and successful. We have just gotten the REIT in successfully brought the REIT in 25th 25th September, and we listed the REIT, and was a very good outcome. The investors like our asset class. Through many engagement sessions with them, it has opened up a new, I would say, group of real estate investors that we have not met even prior to that. That has actually given us that leverage that they're looking not only just on the REIT, but looking at the sponsor as well. So that has also, I would say, as part of the value unlock propositions that we are talking about, has elevated the company in terms of share price closer to what we expect the value of our company to be.
Perhaps I can chime in on what has changed, and I would like to go further back 20 years. Let's look at 20 years. And 20 years ago, I picked 20 years ago because 20 years ago was pre-GFC. Pre-GFC valuation for STI was 2 times price to book, right? 2006. It hit the bottom STI of around 1 time, and now it's improved. So clearly something has changed from then to now. What has changed? And to me, I describe it as the disappearance of the natural investor in Singapore, right? And that has come along with 2 factors. Number 1, the globalization of asset allocation, and number 2, the domination of the US equities market and global equities market. And this globalization has occurred not only for or obviously for institutional investors, because we serve institutional investors, and we have lost mandates investing in Singapore equities because the clients want to invest in global equities, right? The globalization of asset allocation. And to truth be told, they have not been wrong, because this asset class has done very, very, very well. And people tend to look at recency bias, right? Recent investment results. And that is kind of self-enforcing. It's like, why bother? Just invest in the S&P or global equities. That has even pervaded to the retail investors, right? It's so easy to open a Moomoo account, buy NVIDIA, buy Facebook. You don't have to bother with local companies. And I dare say that anybody below 40 years old has not seen a bull market in Singapore equities before, right? So it's so strange, right? To them, it's like, oh, Singapore, there's stocks worth buying. So that has come alongside. That to me has been the major change that has happened between 20 years ago and now. And in the last 1 year, this change has begun to reverse, right? There has emerged now a natural investor in Singapore. That's EQDP, right? And alongside with that, the awardees, we are very thankful to be awarded, have committed to raise money investing alongside with MES. So doubling down in terms of the natural investor in Singapore. So to us, the future has to be growth of that natural investor and policies that encourage that sort of growth, right? There are many thoughts around how that can be done, and we can talk about that. But that to me is the way forward. Because if you look at markets which trade well, markets like Malaysia, Australia, what's the differentiating factor? Natural investor. The pension and government-linked endowments in Malaysia, the super funds in Australia. I think that's no coincidence. That's no coincidence. So it behooves the local funds to look at the local markets to see whether that's something that can be worthwhile allocation to. And especially in terms of where global markets have come, where valuations are, and whether that matches in accordance with their asset liability sort of management.
Got it. So let's hear from this way. Companies doing the right thing. So you hear from the heavy asset to the light asset strategy working very well, which allow the Chee to achieve the 3x, but still your P ratio is on the value. And then the Huan said that because of the last 20 years, competition for the money in Singapore is actually facing the more challenge. So there are more more supply, more attractive supply happening in the market, right? Like a US stock market, right? So even though the company is doing the right thing, the capital market competition, it may happen. Do you agree, Michael? Is it SGX is competing against the other stock exchange, right? And then, so then if it's true, then how can we attract the more money to the Singapore?
Yeah, maybe I'll also add on to what Yuan said about, I guess, geographical competition. I think the competition is not only in or between markets, global public markets, but it's also with private markets as well. I think in the last 10 years, what we've seen are more investment opportunities for investors, not just investing in public markets, but also private markets, alternative assets that are now having an easier access for retail investors. I think that's the challenge for the money that our public companies need to contend with. As a market itself, as global public markets ourselves, I think we are also competing with the private markets for companies that want to list on public markets, because it's much easier to access private markets from the company's perspective. You can deal with just a few professionals, fund managers, and PE funds, and get the funding instead of going through a very detailed, committed IPO process. So I think that's something that I think the review group has also taken note of in terms of trying to streamline the IPO process, to streamline the review process so that it is easier. But I think the attraction of the public market still stays. It's, from the investor's perspective, it's still offers the best transparency in terms of corporate disclosure. In a public market, you are able to know what's happening to your portfolio companies. You have price transparency as well as liquidity, much easier to enter and exit than from private markets. But I think the challenge now is to make sure that the valuation of the public markets can meet those of private markets as well. Now, if you take a look at the maybe EBITDA to purchase price multiples of PE exits. So in 2020, the number of PE assets that are exited into the public markets were at a 15 to 16 time PE versus an acquisition multiple of 9 times. But in 2022, the PE, the ratio, the multiples that assets were acquired was at 15 to 16 times. So how much higher of a multiple do you think they will need in order to exit into the public markets? And I think that's what Minister Chee was saying about having an efficient and effective enterprise financing system. We need to make sure that the public markets are there in order to allow private assets to IPO, to exit, so that capital can be recycled. And that's why a lot of the initiatives are focused on ensuring that the valuation, liquidity of public markets are also commensurate with that of the private markets.
Got it. Thanks. So competition is real, not only just the public market, also even private market, right? But we are not too bad, right? So, but you know, we had some question, but let me ask it this way: as the stock market has a different characteristics of the discount or strength. Like U.S. tech companies, maybe a handful of the 10 companies that accounting for the 40%, 50% of the market cap. Korea conglomerate discount really matters, right? So which is now fixing. That's the reason why we see the big high. What's the characteristics of the Singapore exchange market and the where we are missing out the opportunity or you are seeing the opportunity?
So this is a bit of our sales pitch. What's different about the Singapore market, right? To me, I would say that Singapore is a very well managed economy, very resilient, and that actually plays out in its listed companies as well. We have very strong listed companies, especially the big caps, but also some of the mid caps, very resilient, very aware of paying out decent dividends to shareholders. Okay, and so if you look at the metrics, right, the real standout metric for Singapore, the Singapore market, is the dividend yield. Today, the STI gives a dividend yield of just under 5%. That has come down because market has gone up quite a bit, but that is still head and shoulders above. It's incomparable. I think the nearest market is probably Hong Kong. That's probably like about 3%, or Australia. Those are quite high, but we are head and shoulders above any other market. That speaks to the quality of the cash flows, the balance sheets, and the willingness of Singapore companies to return capital to shareholders. And so you talk about where's the remaining, or what excites me, right? I think that valuation does not pervade from the large caps to the mid caps and small caps. And to me, the mid and small cap space, even though the opportunity is not homogeneous in terms of where the value is quite granular. You need to roll up your sleeves. You need to understand the companies. You need to understand the businesses, as sometimes for many years to understand that these businesses are structural. But that is where the value is. It is a very it's roll up your sleeves kind of business. You need to do your deep research. It's very granular. It's very fundamental, bottom up, company by company, and we are up for it. That's what really excites us in terms of discovering where the change is, where the value is among the mid and small caps in Singapore.
What is your definition of the SMB here?
Right. So we follow kind of the index definition. So if you look at the ST mid cap, the largest companies are about 8 to 10 billion Singapore dollars. So we consider that the upper end of the range, but we are willing to invest in below $1 billion in terms of valuation, even
below $1 billion, right? Chee, I think you have the good opportunity to persuade him, right? To join you.
We are happy shareholders.
Yes.
Happy shareholders.
Chee, what did you yourself to pitch, right? So once again, your P ratio, everything can be even better, even though you achieve the 3x of your stock value, right? What could be your 3 things you want to do unlock your value? And if it's a sales pitch to the capital market.
Okay, this is based on what the consultants told us as well. Okay, not only just my perspective. Of course, for for the sponsor, we have actually parked all the more matured assets to the REIT. Of course, to the REIT, I believe that it will do very well, because I certainly we believe the asset class is by itself in a very safe space and also very resilient, as proven during pandemic, which is why I think it has done well. The question is how to grow them, right? So for the sponsor, we will go on the more asset-light strategy. we would actually, because of the recycle of capital, some parts of it, we really didn't exit much in terms of the portfolio, but we do have some funds that we can recycle. We intend to actually deploy the funds in developing the assets, because this special asset class, it is not like you can do a lot of M&A, particularly in worker accommodation. You need to ground up, you need to build them. So we will deploy this to build them, and thereafter mature, stabilize, mature, inject into the REIT. And this is how we are going to grow our AUM. That's the strategy we are talking about. But for that, what does it accrete to the sponsor? The sponsor accrete not only the development profits, because we do create, sell, development profits, recycle, and keep on growing. That's one way. Plus also the fact that we have, because we are managers ourselves. Like what we are operator. We manage the assets. We get our hands dirty. So property management we do ourselves, because this is not like normal ordinary real estate class. It needs a lot of manpower and also a lot of expertise to deal with them, because we have 70,000 of migrant workers to manage, right, on a daily basis. Then on the other hand, we look at that in order for us to do well, this is in order to do well, this is where we needed to expand our portfolio. Plus, by doing that, we will accrue a lot of management fees too. So it's a more fee-based income to the sponsor. And for fee-based income based on the consultants, then P, in terms of P ratio wise, would actually be more suitable. And that would actually increase the valuation of our counter. And that's what we intend to achieve.
Got it. So capital recycle, also performance based, the management, right?
Yes.
I think I see a couple of very good questions. How many minutes do we have more, Jeremy? 10 minutes? 5 to 10 minutes. Okay. So then I want to pick up this question, but this the last one now is the question that I want to. You heard about the good strategy there, right here. But board of directors, you are not in the driver's seat, right?
Yeah.
You are in the passenger seat. How do you influence the company's change of the management skill set, right? Sometimes do you see the conflict? And then if you see the conflict, how do you manage when you are sitting in the passenger seat? Because Michael also, you can pick up this question, because independent board of directors getting more important, right? So how does it really matter? So what's the role of the board of directors before we finish, picking up some questions?
So I'll start off by saying that we influence companies' decisions mainly by directing capital, right? That's our role in the market. Our role is to find recipients which are worthy of our clients' investments. And we direct capital to these companies in terms of just buying the shares, or if there's any corporate issuances, then we participate. That's our role. We see that as our role. And as more recognition is given in terms of the flow of money to these companies, then naturally the valuations will improve. So that's what we see our role as. We engage extensively with management, sometimes at the board level, but always at the senior management level, to understand where they're coming from. And very, very, very often, the senior management are representative of the main shareholders and the board anyway. So we influence through these kinds of engagements and through directing capital in that sense.
Michael.
Yeah, I mean, I've mentioned about how having the right board ensures that strategies are well executed, that you can monitor and supervise and implement your strategies. And I don't purport to tell a company how to run the business, but I think there are a few areas that we've seen which are very salutary to unlocking value. I think one, as you has mentioned, is about the dividend policy, making commitments for dividend. We've seen that for larger and mid caps. How do we make sure that smaller caps also make that public commitment to dividend policies in order to instill confidence of investors in their business? I think another area is on investor relations. How do we ensure that companies are well equipped to engage with shareholders and other new investors? Kong has highlighted some of the schemes available, like Elevate and Equip. So these are, I think, schemes that we encourage our companies to take advantage of in order to unlock value and maybe have a meaningful conversation with investors so that it can be a reinforcing cycle. I think the last is also from the remuneration perspective. Are incentive frameworks within the company set up to incentivize value unlocking initiatives? So again, that's something that we hope companies can take a look at, their remuneration policies for enhancing corporate performance as well as unlocking shareholder value. I think the last thing maybe I'll mention is on forward-looking statements. There's a question there.
Yes, I see that.
And I think Minister has said that our companies are rather reticent in talking about their future guidance, and I think there is a misconception in the market that this is not permissible. So maybe I can disabuse everyone of this notion that forward-looking guidance, forward statements are indeed permissible. I think the only guidance we'll give is that these are prepared carefully, they are soundly based, and they are realistic. From the regulator's perspective, as I mentioned, I'm not there to run the company. Wouldn't know your business as good as you, as well as you do. So long as when you make those assumptions, those are your best estimates of what's going to happen, and that's what you communicated to companies. I think as regulators, we'll be very slow to interfere, and we also give deference to your judgment on how you have arrived at those decisions, so long as they are realistic and they are consistent with how you've seen things.
Got it. So I think that's the one, because now we are entering all this AI digital. It's more like an inflection point of the sector change. Then we can't just look back and conservatism, right? We are encouraging the more future forward statement, everything, right? So then I also like some of the questions. So some of the people ask the question, some profile of the SMB or even larger company, they want to be in the dark side, want to be in the shadow. They don't want to build out to the public profile. You see those cases, because when you find out to the very good company, but they are not willing to change, or they're not willing to build a public profile. Is it really true? And then how do you talk to them?
Yeah, so I mean, it's the difference is whether you really care or not about your share price, right? And Centurion is one of the it's a very good example. As in they are a poster child for caring that the share price is reflective of the business, that the share price functions for them as a avenue for raising funds. Many companies don't, and when you don't care, then that's perhaps the domain of regulations or incentives to perhaps bring in independent directors who do care. So for us, I think that if there's a will, there's a way. There's a question on skill sets. I mean, everybody has a fair valuation. We can, of course, discuss what that is. So for us, we're looking much more for intention, and then willingness to kind of think about where the gaps are and how to bridge that gap is the main thing. Yeah.
Got it. Chee, this is a very important question, right? You heard that about, and also some of the question is dividend versus growth, maybe short term versus middle and long term, right? How do you make up that balance, right? Because when you're asked to pay the more dividend, however, you still need the money to buy the new asset class. How do you make up that balance? And then how do you communicate with that?
Okay, so when we go for investor roadshows and all that, I think the first question, or maybe the last question, is that what is your dividend policy, right? So it has always been communicated to say that, well, we are not a REIT. I'm talking about a sponsor. While I want to give dividend policy, but basically we are looking for growth. So we do need flexibility in terms of not locking ourselves into a dividend policy. But we have communicated to the investors that if you look at the track record and every time we've been providing, we are actually very disciplined in terms of giving dividends. And the dividends is actually a ratio of our, I would say, core cash flow profits, right? And we consistently paying. In fact, our dividends has actually been increasing over years because of our better performance. That is actually how we have conveyed to them. But of course, everyone wanted high dividend. Share price goes up high as well, which I think is not going to happen, right? But I would say most of the investors, or particularly the institution investors, do understand. And that's the difference. And with the EQDP and all that, we will see many more investors. In fact, for us, we are listed for a while in Hong Kong, right? For about 5 years, dual listed. The reason is actually unlocking value, okay? Right? To recognition of value, maybe in Hong Kong, different deeper investors and all that, but it doesn't really that happen. Because why is one fundamental thing that we realize that, well, what is a market cap? So it's a chicken and egg thing that we are talking about. What's a market cap? What's a trading volume, right? Liquidity. It falls back all to this. Which is why I think there's one question about, how to encourage or listed companies in shadow, why in the first place that they are keeping in the shadow. I don't know why, right? Why are they doing that? Because being a listed company, I mean, there must be a purpose of you being listed. You wanted to grow, you want to big, and then you want to access to cheap capital, right? This is what the ultimate reason for being listed. But I guess a lot of them may think like what we think 10 years or even 20 years ago, okay? Because whatever we go and talk to the investors and all that, the investors only look at, well, perhaps it's a wasting of your time. Because whatever we communicate to them, yes, we like your story, but we can't invest in you. Why? Because your market cap is like that. You have to wait, right? But to us, we are not discouraged because the investors always comes back with one. Doesn't matter. We know your counter, right? We know your whatever. It's a long-term thing. It's not a short-term thing. So you don't expect that after days, straight away your share price will go up. It just don't happen that way. But after a while, they recognize that we will hit them a few more times, just like what we did, right? And then during even listing to the lead, or was it leading to the REIT, a lot of investors who have actually met us know us already. That makes our process in the REIT even smoother, right? That is something that I think the listed companies has to think about. There's no with now the EQDP and all the initiative, equip and elevate and all that. These are free platform or resources that we could tap on. There's no downside, right? There's only upside. Why not try, right? So that is the mentality that we will be adopting, and I hope that listed companies will do the same as well, because that is the ultimate game of why in the first place you're going to list in any case, right? Whether controlling shareholder or not, because he did mention about in Asia that's a lot of shareholders are major shareholders. They have controlling the company and therefore not so upcoming in terms of doing all this value unlock program. Right.
Thank you. To wrap up the session, right? So I want to pick up the question around what's the opportunity and challenge for the SGX in 2026, right? Also, can you also comment on how can we help the SMB who is under shadow of this or the potential opportunity?
Sure. Maybe I'll just quote what Min Chee said earlier this morning that, we've already put in the EQDP program, but one of the most important people in this whole equation are the companies themselves. They need to be able to leverage on this opportunity to attract the investors. And I think what it really means is for individual companies to develop and tell their own equity story. There are different profiles of investors who want different things. There are different companies with different competitive advantages. So as an individual company, I think it makes sense to take a stock take of where you are, think about where you can grow realistically, what are your opportunities to play, and then start working on those. Maybe as a framework, I think I can maybe share a very broad brush way to look at strategies for individual companies in order to grow. You can look at it from the business side of things, either growing your revenues, looking at your margins, looking at optimizing your portfolio by divesting underperforming assets or spin-offs to unlock value, like what Jiming has done, or to look at accretive M&A opportunities and targets in order to grow from the business side of things. Then there is the capital side of things in terms of strategies to make sure that you have an optimal capital structure. We talked a bit about having a cost of capital being conscious of it, and then working to make sure that it's efficient. Looking at your liquidity management, or looking at dividend policies, as well as share buyback arrangements. I think these are broad areas that companies can look at, and through the, I think, equip and elevate schemes, companies can delve in deeper into each of these strategies to find out what really works for you.
Thank you, everyone.
Thank you, everyone. I think it's all very informative enough, productive enough. We heard about a lot of the great ideas from your investment purpose or from your company own, right? What's the initiatives? Value unlock is not just the only one-time trend. It's a very continuous effort, working with all the different participants of the ecosystem, right? Thank you for all the panelists. Thank you for all of you.
Thank you.
Thank you.
Please help me thank once again our panelists, Joong, Shik, Michael, Huan, and Chee. Thank you for your valuable insights today. Hope it's inspired lots of thoughts to start off this value unlock journey for the year and the years to come. Thank you everyone for coming today as well.